Hey people, what's going on? Welcome back to the channel. Right now we're on a Guardian article taking a look at Bank of England in terms of long mortgage rates happening right now and the rise of credit card use amongst British public. Let's take a look. So it says here consumers are taking longer mortgages and spending more credit cards in an attempt to adapt to higher interest rates and living costs, potentially stalling up debt troubles in future, the Bank of England has said. The Central Bank's Financial Policy Committee, which keeps tabs on the health of the UK financial system, has seen evidence over the last 3 months of basically some households increasing reliability on credit cards to make ends meet. Obviously, you got the cost of living crisis and these issues where more people are struggling now financially. Now, consumer spending was under pressure as higher borrowing costs due to the continued rise in interest rates and the cost of living pressures meant many were having to find other ways to pay for everyday purchases. While the annual rate of credit card spending growth was relatively stable, holding steady at 11.8%, the committee said the trend could lead to greater debt vulnerability for households in the near term. Now, prospective home buyers have also been adapting to financial pressures by taking out longer term mortgages. So in total, the proportion of mortgages lasting 35 years or more has gone up around basically from 4% in the first 3 months of the year to 12%. So that is quite a big increase in the second quarter. Now, obviously, the UK has a relatively short-term mortgage market compared with other countries like the US, where the average is like 23.3 years. While longer mortgage terms and other forbearance measures could reduce pressure on borrowers in the short term, they could increase debt burden over a period of time. Now, the FPC also noted an increase in borrowers falling into arrears a bit from low levels and expected the number of customers falling behind on their debts to increase. So banks have simultaneously started to tighten their lending amid fears of the economic outlook. But overall, the UK banking system, which broadly is basically in decent nick, and asset quality remained relatively stable. However, it said that the potential risks were somewhat offset by rules set by the FCA, which require banks to be responsible lenders. Meanwhile, the bank announced it would pause its normal stress test, which ensure the UK's largest high street lenders can withstand severe financial shocks and, amongst an extreme downturn in the UK and global economy. Obviously, we live in an unpredictable world, so, anything can happen. Instead, it would run a desk-based scenario, similar to checks conducted during the COVID crisis, which would measure the health of the banking system as a whole without having to publish the results of individual lenders. The committee said that, basically it would allow it to test banks' balance sheets against more than one scenario, including whether interest rates stayed higher for longer or suddenly dropped and affected bank income. Now, this will also give policymakers an opportunity to review the normal stress testing regime, which was implemented after the financial crisis and could end up including a broader range of lenders, including smaller banks. Now, the banks run annual tests of the largest lenders, such as Barclays, Lloyds, HSBC, NatWest, Santander, UK, Standard Chartered, and Nationwide and Virgin Money. Now, the bank is preparing separate stress tests for the shadow banking sector, which includes hedge funds, to measure the risk of amplifying shocks to the financial system. Now, the terms of tests will be released in November. So, according to the International Monetary Fund, global stress tests found that up to 30% of 900 banks across 29 countries would be vulnerable in the event of a prolonged period of stagflation when growth is weak and prices are rapidly rising, which is something that we might be seeing here in the UK very shortly, if it's not already happening. In its Global Financial Stability Report, the IMF said only 5% of banks would face difficulties if forecasts for steady 3% growth came to pass, but said the outlook would be much grimmer in the event of this adverse scenario in which the global economy shrank by 2%. Now, also the FPC called for stricter rules on how quickly money market funds, which invest solely in cash or cash equivalents, like government and short-term corporate bonds, could sell off their assets. Now, also the call follows a panic sparked by the dash for cash at the start of the pandemic in 2020, which resulted in investors pulling their money at speed, as well as the UK pension fund crisis in September 2022 that was originally prompted by the government's disastrous mini-budget but caused UK bond prices to plunge at a record rate. Now, the FPC is urging the FCA, which regulates the sector, to rule that 50-60% of money market fund assets should be be able to get liquidated and sold off within 7 days. Okay, people, please do like, share, subscribe, comment below, let us know what you think. Catch you in the next one.